It's Friday, May 3rd. Let's dive into the catalyst moving the markets today. It's Goldilocks. The job market added 175,000 jobs, coming in lower than estimates. The big number the Fed will be watching is wage growth, up 0.2% over the last month, lower than the estimate of 0.3%. The bad news is good news, print pushing stocks higher across the board this morning.
And Apple shares rallying following that record-breaking buyback announcement. iPhone sales still an issue. The buyback buying Apple some time while the market awaits the next catalyst for the stock, AI-powered products.
And Block, remember them, doubling down on Bitcoin. The fintech company saying it will invest 10% of its gross profit from Bitcoin products into Bitcoin purchases every month. Bitcoin is ticking higher, now over $61,000 on the news.
But first, today's biggest driver is the jobs report. What might be good for the Fed, not always good news for the everyday consumer. Wage growth taking a little bit lower, softer, I should say, in April, now at 3.9% over the last year, compared to a 4.1% growth that we saw in March. And Sazi, it's interesting to look at this wage growth number because this is what my sources were telling me was the key thing to watch. They were saying we don't want to see wage growth ticking up. Obviously, it's still on the upside here, but we're seeing the pace of growth slowing a little bit. That is potentially good news for the Fed. We're seeing this market pricing in 2 cuts this year, up from the 1 cut this year that we saw earlier this week.
Well, my source, my mom, is still seeing prices up very, very high in the grocery store. I don't know if she's really seeing any prices coming back. But anyway, why are you seeing the market rally? And I think you nailed it, Madison. Now you're back to that thinking, do you get a rate cut at some point this year? Now, I've been talking about rate hikes the past few weeks. I'll put it out there on the table. I don't think that's necessarily off the table yet. That's just my view. But again, this is a market looking for any indication we may get 1 or 2 rate hikes at any point in this year. And this report is something that ultimately fuels that narrative.
And it's interesting because we saw the employment cost index coming in hotter than anticipated earlier this week, leading to a lot of volatility in the market. We saw a spike in the VIX that day, downside, of course, in the major indices. And now it seems like that happened 10 years ago.
You know it's crazy, Madison. What, wages were up, 0.7% or around there? Yet you go to the supermarket and you see prices for chocolate up 10%. Something's not wrong. Like, you're going broke buying chocolate. But
right.
I always laugh at this government data. It's a real joke sometimes.
Well, and questions remain about the data, but that's what we got to look at.
Yeah, no, it's our job.
We got to be data dependent, like the Federal Reserve.
Ooh, nice.
All right, could this print be enough progress for that Federal Reserve? Yahoo Finance asked some experts just that after the numbers broke. Here's what they said.
Chair Powell said he needs a meaningful increase to unemployment, and we're not there at meaningful yet.
I think the Fed's going to be happy that wage growth is cooling, and maybe some of that heat they saw in the job market in the first quarter is moderating to some extent.
Our next guest saying that he is keenly watching that wage growth data point, and he joins us here right now. We've got Stephen Parker, JPMorgan Private Bank Head of Specialized Strategies. Steve, thanks so much for being here.
Good to be here.
Love the bow tie.
Thank you.
And the Nikes. So let's talk about this. Are we officially into Goldilocks zone? Are we out of any question mark on that?
I mean, I don't know that Chair Powell could have asked for a better report than what we got today, right? I mean, we got the cooling in the labor market, which is what we were looking for. Wage growth is decelerating, but still at a healthy level. So the growth picture still looks pretty good. But the inflation pressures seem to be coming off the boil. And he was pretty clear in his statements earlier in the week. Hike wasn't in the cards. Today just reinforced that case.
Isn't this the worst thing that President Biden wants to see? A job market slowdown, a report that misses estimates, but also prior month revisions to the downside too?
Well, the revisions were slightly negative, but at 175,000 jobs, that's still a pretty strong level, especially when you start thinking about this not just on a month-to-month basis, where there can be some noise in the report, but the average over the last couple of months still indicates a very strong labor market.
Why the slowdown?
A lot of the slowdown, if you look through the data, actually took place within government hiring. So that was one place where there was a bit of a surprise to the downside. I think that's probably less reflective of the overall economy in general. So that's another potentially positive sign. I think the rate that we were running at for the last couple of quarters, I think was probably unsustainable.
So I want to look at one data point, which is underemployment, this U6 number, up to 7.4% from 7.3. This is a data point that looks at whether or not people are getting the amount of work that they're craving, right? How big of an issue is that when we think about company fundamentals and what that could mean for investors moving forward? Could that be a problem?
No, I don't think that it's a big problem. The interesting thing is when you look at the high demand for labor that we've been seeing over the last couple of months, it's actually been met with a high supply of labor. So that's why we haven't seen the wage pressures necessarily manifesting themselves. I think companies are doing a good job in terms of finding the right equilibrium in terms of their ability to hire and find candidates.
So I'm curious, if we start to see the consumer buckling because their wages aren't keeping up with the pace of inflation, does that put a crack in your argument that there is a broadening that is going to be happening in the market if consumer names, for example, can't keep up?
Again, we have to think about the balance between the direction and the level. Wage growth slowed down, but it's still at 3.8, 3.9%. That's a lot higher than where we were pre-pandemic for a really long time. So I don't think that necessarily is going to be the thing that crimps the consumer. I think consumer spending can remain strong, confidence is high, and I think that's a good environment.
Those bullish the market, do they now need to root for bad data to be the catalyst for the next move higher in markets?
I don't think so. I think what we want to watch for, the worst case scenario was this stagflation conversation that people were starting to have over the last couple of weeks, where unemployment is moving higher, growth is moving lower, inflation is persistently sticky. We're not seeing signs of that. That's the environment that I think would take us to risk off. I think if we can get to a place where markets are more comfortable that the next Fed move is going to be a cut, that inflation is trending in the right direction, you can take that strong growth environment and a really healthy corporate earnings market, that can move us higher.
How should investors play the idea of broadening?
So we think a lot of the rally that we've seen over the last couple of years has really been led by the US. We think we're at a place where that can begin broadening out globally, and in fact, we're starting to see that. Markets like Europe and Japan, I think, present really attractive opportunities. It's a place where a lot of investors are underexposed because the US has done so well. There's a really good story. You think about Europe, we think the growth is about to start reaccelerating. The European Central Bank is likely to start cutting rates before the Fed. And the corporate sector is actually starting to deliver on earnings, buybacks, higher dividends. It's a really compelling opportunity.
Well, thanks for swinging by Yahoo Finance headquarters on a Friday. Stephen Parker, JPMorgan Private Bank Head of Specialized Strategies. Really appreciate it. Thanks so much.